So before I start, I just want to make it really clear to everyone that everything I'm going to talk through today can be accessed via the VFD portal. I'm going to and can be accessed by connecting a client in the way I'm just going to show you now, because I'm aware there are some people that are unfamiliar with VFD on this call. So effectively, I'm going into my company, I'm adding a client, I'm going to call this client a webinar demo. I'm going to give it a company number, but it doesn't exist at the moment. I'm going to tell it the most recent date the accounts are up to date to. I'm going to pick the accounting package that I want to connect to, and then I'm going to scroll down. I'm going to pick a grow and exit connection type, because we're going to be talking about EVA today, which is only available in grow and exit. I'm going to click save. I'm going to connect to Xero. I'm already logged into Xero. I'm going to select my company from the drop down list there, and I'm going to click continue. This next step you won't have to do. It's only because I've loaded the demo company a number of times, and that's it. So everything that we are going to access today gets generated as a result of selecting the grow and exit connection type, going through the process I've gone through. Your little grey paper icon will turn black in 30-40 minutes, because we're running the full suite of VFD Pro content, and then you access it via clicking on the black paper icon to get the full suite of VFD Pro output, of which EVA is at the bottom. So what I'm going to do whenever I show you any content from VFD Pro today, I'm just going to show you some of our demo content. So everything I'm going to go through, everything in today's webinar is accessible via the way that the process that I've just gone through. What's today all about? Well, today is all about ensuring that we can help business owners successfully exit their business from and I will stress this, from a financial perspective. If any of you have been on the Exit Planning 101 course that we've done, you'd have seen there are far more non-financial elements to exiting a business than financial. What we're doing here today is we're focusing on the financial elements and effectively those elements which you can assist your clients with through with the assistance of VFD. And that's what we're going to focus on today. So I'll give you a bit about my background. So I'm a 24 years post-qualified accountant. First 15 of those years were spent in industry. So I've been FD for cooperative food, and I've been FD for kind of cruise lines. Then I spent a period of about 5 to 6 years operating as a portfolio or part-time FD or fractional FD, whatever you want to call it. Essentially, I looked after somewhere between 7 and 10 SMEs at a time, ranging from everything from ripping entire finance functions out and putting in new people, systems and processes, right through to buying and selling around about, or assisting with the buying and selling of around about 10 businesses during that time. And then the past 3 to 4 years have been solely focused on VFD, which is essentially automating a lot of the work that I had to do manually when I was a part-time FD. So that's a bit about me. So financial due diligence. What we're going to do today is we're going to go through the process of financial due diligence and also business valuation, and also how you help your clients achieve a desired exit. So I'm just going to put up on the screen, I'm not going to read it out to you. These are some of the subjects that we're going to cover today. And what I'm going to do is take you through the approach, and also I'm going to link that into how VFD can help you achieve a lot of what we're going to go through. I'm going to start off with a question, and that question is, and this is where I want you to use the chat, just first of all to see if you're all awake and whether I haven't sent you off to sleep yet. How many business owners will exit their business? Give me a percentage, and put that percentage in the chat. Okay, so we've had one response, and thank God it's the right response. Well, someone said 90%. It is 100%, because they'll all exit at some point in time. So the only purpose of that is 82%. That's very specific. from somebody. The purpose of that question is a loaded question. Effectively, all I'm saying is this is applicable to every single business owner that you support. They're going to exit their business at some point, and this is about what we can do to help them achieve their desired outcome. So, what I'm now going to do is just go on, and I'm going to talk about financial due diligence, and if we're looking at today's webinar that I'm going to go through, we've got financial due diligence, and we're going to look at it from what we're going to look at is both a buyer's and a seller's perspective, because essentially financial due diligence is essentially just a systematic approach to understanding how an independent observer would view the performance of a business, and that's it. If you're looking at it from the buyer's perspective, then, well, the buyers are seeking to understand the risks and opportunities present within a business they're looking to acquire. And from a seller's perspective, they need to understand how a third party is going to view their business based on facts alone, taking all of the emotion out of it. So what we're going to go through today is just as applicable for both buyers and sellers. You're just viewing it from a slightly different perspective. And whether we're looking at it as an asset purchase or whether we're looking at it as a shares purchase, we still need to take into account a lot of the variables that we're going to look at anyway. So the point there is that it's just as applicable from both the buyers and the seller's perspective. Okay, so what are we trying to achieve? So from a financial due diligence perspective, we're essentially trying to gain a sound understanding of the historical performance of a business. We want to assess all of the profitability drivers over the last few years, and essentially we want to learn enough. If we're buying a business, we want to learn enough to be able to understand what the future might look like for the business. We want to understand whether there's any inherent potential financial risk. Again, I'll go back to point, this is financial due diligence. There's a lot more due diligence that goes in place from a legal perspective, from an HR perspective, but this is from finance. So we want to understand whether there are any inherent potential financial risks. We want to understand the state of play with regards to the business's assets, liabilities, any contingent liabilities that are on their balance sheet. We want to be able to evaluate any potential synergies. So if we're buying a business, whether it's a horizontal or a vertical integration, we want to try and understand how that business can add value to our existing business if we have one. We want to use it to generate a fact base for our that can underpin the valuation exercise that we're going to go through. It's going to form the basis for price negotiations, and it's also, we're going to use it to assist with any potential funding applications that we might have to make as a result of this business acquisition. I guess what I'm trying to say is, most importantly, and please forgive my forgive this next picture, we just want to make sure there aren't any skeletons in the closet, which is ultimately what we're trying to do as a result of this. Give ourselves a good sound understanding of exactly what's happening from a financial perspective right across the business. Okay, I'm going to put up two words here. We've got audit and we've got financial due diligence. I just want to take a bit of time to talk about, now a lot of you will be accountants on the call, so you know exactly what I'm talking about. And I'm not saying I'm not saying this is 100%, but essentially trying to get across the difference between financial due diligence and an audit. Essentially all I would need to do is put one picture behind that. Hopefully you can all see what that is. It's supposed to be a car windscreen. If we're talking about an audit, we're talking about we are concerned in the main. I know we talk about partly what's going to happen in the future, but in the main we're talking about historical financial statements and providing an opinion on whether they reflect a true and fair view of the company's operations. From a financial due diligence perspective, whilst it incorporates what has happened in the past, it also focuses a lot on what's going to happen in the future. So we use the future to help us not predict, if you like, use the past to help us predict the future, if you like. So we don't just look at what's happened in the past. We might do some forecasting to help us understand what performance is going to be like going forward. And we're going to provide a rounded view of all of the financial risks that might sit within that business going forward. So just a little bit of a distinction between the two, and certainly from the perspective of today's session, we're going to focus more on the financial due diligence than we are on the audit, clearly. So the next thing we're going to look at is the information. So typically, what information should we use? Now, having done this a number of times with a lot of businesses, so I've reviewed probably close to 30 or 40 different businesses in the past 5 to 10 years, and typically this is what you'll get given. So if I'm buying a business, this is typically what the seller would give you, and if you're selling a business, this is typically what you would provide, which quite frankly is no good whatsoever, because 3 columns on a spreadsheet with performance is nowhere near enough to enable us to understand exactly what's going on in business. But predominantly, if you go to a business broker, this is the information that you'll be given. You're expected to make a decision based on that. From a financial due diligence perspective, we kind of just want to look at 3 main areas and then understand and assess those areas. So we're going to look at the income statement, or P&L, whichever you want to call it. We're going to check for volatility of earnings. We're going to closely examine the expenses. We're going to understand the headline revenue numbers, understand whether there's any risks or opportunities present within those numbers. We're going to analyze the client base to understand what's going on there, what's happening. From an expenses perspective, we're going to look at the any exceptional items that enable us to account for one-offs. And what we're typically going to be looking at is performance over the last 3 to 5 years. From a balance sheet perspective, we clearly want to understand the business asset position. We want to understand whether there's any value in those assets, or whether they're just assets on paper, effectively, with no useful life or value left. Going to particular attention to any liabilities that currently sit within the business, any contingent liabilities, and then we're going to look at cash flow and just understand how the business has generated its cash over the past few years. We're going to check the quality of those cash flows. Hopefully they've always been positive, but if they haven't been, why they haven't been, and just understand what their key drivers of working capital have been. So what I'm going to go through now, I flicked on, what I'm going to go through now very, very quickly, so this isn't all about a product demo, but I'm going to go through very quickly what I would expect to see in a financial due diligence report, because what we're going to do is we're going to use that report in a live example. So if I go back to the portal, I'm going on to my demo company and I'm looking at my EVA due diligence report. Again, this is automatically produced as a result of that synchronization, that 10-second synchronization that I performed at the start. I'm just going to click download, and then I'm going to open the document. So what we're going to go through, excuse the logo, this is our demo company, so we haven't put much thought into what a logo might look like for a demo company. But first thing to note, VFD is a white label product, so you can have your own logo, your own color schemes on there. What we're looking to do, and I'm going to pick up some of these areas and I'm going to flick through. I'm not going to spend the entire time going through a 26-page report that gets produced for you. I just want to talk about the main things that you're going to be looking at, and I thought better to do it in a live demo than on screen. So first of all, we just want a really high-level overview of what's happened, picking up the key P&L and balance sheet lines over the last 3 years. So how's my revenue, my margin rate, my overheads, my profit, and net worth, cash, AR and AP. So I'm looking at my receivables and my payables, just a really high level overview, what's happened. Then what I want to do is I want to take each of those areas and I want to go drill down in depth into each of those. So as an example, now we've got a page on revenue. So there's my annual performance over the last 3 years, again at the top. Key things here I want to look at is I want to look at overall what's the direction of travel. So in this instance, over the last 3 years, compound annual growth rate of minus 6.1%. Okay, so we're heading in the wrong direction. And then I want to look for variability. So where are my variability of earnings? Is there any seasonality present within the business? So here, I just want to highlight that and pull that out by looking at the monthly performance over the last 3 years. Then I want to look at revenue by quarter. So I want to understand each of the last 4 quarters over each of the last 3 years, how they're all performing against each other, just to highlight where that increase or that decrease might be coming from. Is it specifically relating to a specific quarter? And then finally, what I want to do is I want to use the past to predict the future. So I'm going to take what's happened within this business. I'm going to apply some averages. So I'm going to take the last 3 months, 6 months, or 12-month average, and then plot that forward to show what impact that would have on revenue. So this is about us understanding exactly what's happened in the past and using the past to predict the future. So this by no means is an exact science and an exact forecast of what's going to happen, because they might have an order book or a pipeline that's completely different this year to previous years, but it would at least give us questions to ask and help us understand exactly what's going on. So we've looked at overall from a revenue perspective. We've looked at what's going on and what's happening within that business. We've helped it understand us. We've helped it help us look at what might happen going forward. And we would look to do that with the other areas as well. So we're looking at customer performance. We're looking at customer risk. Highlight highlight what proportion of revenue is coming from our top 10 customers. We want to understand what's happening with new customer acquisition. We want to understand what's happening with customer retention. We also want to look at accounts receivable, and I'm less concerned about the number, and I'm more concerned about the expectations when we're talking about accounts receivable. So for accounts receivable, it is no good going into a business expecting 30-day debtor days when they're currently operating at 70 or 80. It's an aspiration to get there, but you can't go in with your plan for purchasing that business going forward, setting your aspiration at 30 days, because everyone's just going to carry on paying. They don't care that it's got a new owner. They're just going to carry on paying as they were. So I want to understand that accounts receivable and debtor days position. I then want to do exactly the same as I've done for revenue, for margin, and for overhead. So I'm looking at margin from an annual perspective, the variability between the years, the seasonality in gross margin. Is that impacted across the year? How each of the quarters have performed? And then, as I've done with revenue, I want to use that history to help me project what margin could look like. So if I'm buying a business, this is going to help me in my forecast. If I'm selling a business, well, let's not stick our head in the sand, and let's be really open to the questions that we're going to get as a response of somebody looking into the data that we've got. So understand what that margin might look like and what that projection might look like going forward. We do exactly the same for overheads. And then we combine all that together to help us understand the profit position over the last 3 years and how we've got to where we have. And then also what a projection of profitability might look like, which in this business, in all 3 scenarios, looks like a decline in profit. So if I'm buying the business, I might have about 10 or 15 questions as a result of that first section. If I'm selling a business now, I have to really understand that I'm going to get questioned quite a lot on my performance. They're going to see a lot of risk. A potential buyer is going to see an awful lot of risk within this business. My new customer acquisition was declining. My customer retention was declining. I've got a lot of revenue coming from a few clients. My revenue is therefore going in the wrong direction. Margin looks okay and overheads look okay, but ultimately it's the revenue performance that is driving the future predictions down. So that's the P&L. Again, this is high level to start off with. Then I want to go into the balance sheet. So from a fixed assets perspective, again, I'm less concerned about the number. I'm more concerned about what's happened to that fixed asset base. So if it is an asset heavy business, it requires machinery, etc., to generate the revenue. I'm really interested here to see how much investment there's been over the last 3 years. Because if I've got a business as is this one, which has had we were at 124k asset value in May 2018, and now I'm at 75 in May 2020. I've had very little increase in tangible assets, and all of that decrease has been driven by depreciation. This suggests that this business hasn't had a lot of investment over the last 3 years. So again, if I'm going into a business, am I going to have to buy new equipment? What's the quality of the equipment or machinery or that I've got in that business? So again, that highlights that perspective. We then want to see exactly what those fixed assets are. We want to do an evaluation of net current assets. So look at how the current assets and current liabilities have moved. Just as important as accounts receivable as accounts payable. I'm looking for exactly the same thing. So this business, as an example, I'm going into it, and my customers are on average paying me between 70 and 80 days, and I'm paying my suppliers between something like 20 and 25 days. So I've got a real disconnect there, and I'm going to need to invest an awful lot of working capital at the start of this business just to get going. So it's about understanding exactly where the risks are within that business to help us plan and map that out. We then look at cash. So this business has been in its overdraft consistently for the past 3 years. And then we look at stock in the same way, and we identify the elements of the current assets, current liabilities, and long-term liabilities. What I would then expect, also not only looking at the accounts in general, but then I'd also expect an understanding of who the top customers are, what proportion of revenue they represent, and what their trend has been like over the last 3 years. I'd expect exactly the same with suppliers, and I'd expect exactly the same with our sales channels, or nominals as we call them, to assess and understand how much each of them contributes to the overall total. What I then expect to do, so that's high level, the past 3 years. What I then expect is a more detailed review of the last 12 months, exactly what's gone on, looking at a monthly and a quarterly basis, to understand ultimately how the profit has moved over the last 12 months and how it's got from one place to another. So again, I'm not going to go through this in any kind of detail, but again, what we want to do here is we want to pull out the key questions that we need to ask, and just do a really comprehensive review of the performance of this business. So like I said, that entire document, 26 pages, is all produced in those 10 seconds that I showed you at the start, and then you'll get the EVA due diligence, business valuation, and forecast model as well as a result of that around about 30 to 40 minutes later. So if I now go back into the presentation, and I carry on talking about where we were. So that's what I would expect to see in a financial due diligence report. From a due diligence perspective, there are other considerations, which again I'm not going to go through them in any great detail, but other things that we should look to understand, and rather than just looking at the numbers. One is the process itself. How much time do I want to invest in that process as a business owner, both from a time perspective and a monetary perspective? You can produce that due diligence in a matter of minutes, but it's how much time the business owner is willing to invest in this process. Other considerations that we can't get from the numbers, so key employees. Do we have contracts with certain suppliers that are as a result of employees, or even as a result of the current owner? Do we have any specific skill requirements that only certain employees have, just to highlight those risks? Look at the forecasting of the business. This is a really good one that I used to do a lot. It was look at how they used to forecast. Look at and how they've performed against their forecasts. What we can do is we can look for any benchmarking within their specific market sector or industry, and there is the way up here between for any business owner is, do I want to do this in-house, or do I have the capability of doing it in-house, or do I want it done externally and independently? And finally, one thing that is missed is the assessment of the future management requirements. And what by that I mean, if by taking the current owner out of that business, is there a skills gap that I'm not anticipating filling, i.e. if I'm buying a business, I don't want to go and work in the business. So it's understanding that where that skills gap is and understanding how it's going to be filled. So there's just a few other considerations to take account of. I appreciate I'm going quite fast because I'm trying to cover quite a lot in one session today. So that's due diligence. So that's got us to a point where we now understand exactly what's going on within a business. So whether you're selling a business or you're buying a business, you need to understand exactly what's going on within the business before you can move forward. So this is kind of I like to use the word fact base because it is this fact. It's taken from the accounting package, and it puts down in black and white exactly what those numbers are telling us. What we then need to do, or what we can then do, is utilize that to go on to perform a business valuation. So whether you're selling a business or looking for new investors, I'll go through some of the reasons you might use evaluation in a second. Determining the value of a business isn't it can be done on the back of a fact packet, as we all know, but if we want to do it properly, there are a number of factors which we need to take into account. So I guess first of all, we'll look at why. So why would I value a business? And there are the typical, I know it's a house up for sale, but this is supposed to reflect a business up for sale. So if I'm selling a business, or then I want to value that business, or if I'm buying a business, I want to be able to value that particular business. So that's kind of the obvious reason. Some of the other options are, so we could have a management buyout. So I need to understand the value of the business at a point in time if I want to do a management buyout. If I want to secure investment, or from external investors, then I would need to understand what that valuation looks like. If I want to issue or buy back shares, I would need to understand exactly what value each of those shares is worth. If, heaven forbid, there's a divorce, then again we would need to understand what a proportion of that business would be valued at. If we're looking at consolidation of companies, if I'm looking at buying one company and consolidating it into a group, I need to understand not only the value of that individual company, but also the value of the group as a result of that. It's the synergies that I spoke about earlier. And then what we've also got are supposed to reflect tax implications. So if I want to do something like an EMI scheme or something like that, I would need to reflect and apply to HMRC to get an approved valuation at a point in time. So there's lots of reasons, and there are others, clearly, there's lots of reasons why I would need a valuation performed. So we've got, what I wanted to do was just strike off some of the valuation myths that we've got. So businesses in the same sector use the same multiple. They don't, because there's completely different risks in two different businesses in the same sector. So the multiple might be the same, but that will be reflected, or that will be tailored up or down dependent upon the risk this present within that particular business. There's not one valuation number, there's a range, and typically there'll be a range within which everyone is comfortable. From a buyer perspective, you know that you're not paying too much, and from a seller's perspective, you know you're not getting too little. The potential, this is a brilliant one that I used to hear all the time, the potential to buy a business is far greater than my historical performance. Well, great, so why haven't you achieved that yet so far? A lot of business owners trying to sell on a promise rather than actually being able to reflect that. Now, if you can reflect it, if you can reflect guaranteed income and why your business model might change over the next 3 years, and it's 100% certain to happen, fine, we can do that. But 99.9 times out of 100, that won't happen. We can rely too much on what agents say, and quite frankly, no one is going to give your clients the price that an agent says is worth. They might use that as a starter or a guide or a ballpark figure, but it's never going to be the same. And then the bottom one is really an interesting one. I will always receive the agreed sum in cash. That might be the case, but you'll probably take in a potential buyer base of 100 down to 10. If you're willing to take consideration for a business over a period of time, or in a different way, then that will allow, or that will be appealing to many more buyers than just a simple straight cash sum. So just a few myths there. I guess so when we're talking about valuations, it's all very well understanding the value of a business. You need to understand the value in conjunction with what does the business owner need. If they're going to shake on a deal, how do you know it's the right deal? Because from a business owner's perspective, essentially what they want is reassurance that the capital that they're going to realize from the sale of a business, either in a lump sum or over a period of time, is going to help them and ensure that they can live the life they want to without the fear of ever running out of money. Is ultimately where they want to get to. They come to a point where they understand exactly what it is they need to ensure that there's no risk now in the rest of their life effectively. So 3 steps, and they're 3 really simple steps. First of all, is to understand what their goal is. So what's their goal? What do they want to achieve? It might well be that all they want to do for the rest of their days, they work so hard for their life, they want to play golf 5 days a week and then just sit and watch TV for the rest of the time. That might be their really simple goal, and that's all they want to do. Some people might want to use the money from the sale of a business to go on and create a legacy. And this is just the start and the sale of their business will help them carry on. So we need to understand what the goal of the owner is. Once you know the goal, you understand there's supposed to be a calendar behind the guy on the screen there. You need to understand what we call their event timeline is. So what's going to happen and when in order for me to achieve my goal. If I go back to the example of the individual that just wants to play golf and then sit and watch TV, that's quite straightforward. They probably need to pay for golf membership once a year, and that's about it. And they've got normal living costs on top of that. If you've got an individual that wants to use the sale of a business in order to create a legacy, then there's all sorts of things that need to go on. From a personal perspective, they might still have kids. They might have kids that require private tuition, in which case we're going to need to understand when that carries on till. They might want to move houses, they might want to buy cars, they might want to buy boats. So it's all sorts of things that they might want to do, and it's about understanding and helping them understand what are your goals, and therefore what are the event timelines that are going to need to happen for you to achieve that. Once you understand those two, it's relatively straightforward to work out the cost. So really straightforward. What do I want to do? How do I achieve that, and what the steps are? And then what's the cost? So the future income and the future expenditure. So we also take into account the fact that if you've got any savings, have you got any pensions, so all of that needs to be looked at. Now, there are experts that help in each of those areas, and effectively there are 3 types of assistance typically the business owner is going to need to help them, and that's the financial planning, which is going through the process that I've just gone through. Now, you may offer that yourselves, or there are professional financial planners that use modeling tools to help you do that. Tax planning, which is, I guess, where you would fit in more often than not. So your best place to help understand the tax implications, and this is really crucial because it's not the gross, as you well know, it's not the gross proceeds, it's the net proceeds that go towards helping the business owner live in the life they want to live. So appreciate we'll have to pay tax, which is only fair, but by planning you can avoid paying excessive tax. And then the estate planning. So for some this might not be relevant, but for some it will be. So what do I want to do to ensure that what I get from the sale of my business and subsequently in future years goes towards and help me create some sort of legacy, some sort of estate planning for future generations. So 3 types of experts that can help. So once I know my number, I can then
start to understand the valuation in the context of what I need to do, because a number's a number, and we're fine. Now, what we do is we come up with the valuation. So again, this is where the business valuation model comes into play. So what do I need to look at? So I've got, how do I value a business? And we've got a few different methods that we look at, which all are designed to come up with a range of valuations. So the first one we've got is EBITDA multiplier. So this is your probably the most commonly used in SMEs to get a guide. Based on EBITDA, based on a multiple which is relevant for the industry. One thing to note is that clearly an SME won't have as high a multiple as a listed company, and also it depends on the type of business. If you've got guaranteed if you've got guaranteed recurring revenue, your multiple is going to be much higher than a business that has to fight for revenue and win deals all the time, which is why software businesses are valued so much higher than convenience stores, effectively. For some businesses, it's the revenue multiplier. This is an easier way to understand valuation of a business, and we look at the most commonly we'll look at the recurring revenue, and then we'll understand a multiple of that revenue. We've got an expected ROI. So typically the first two look internally. This is, okay, we'll take my business and let's think about the buyer. Let's think about what sort of return they want to get on their investment. So I can put my money, if I've got £1 million to spend, I can put it in a managed fund, and I could probably get, if I put it with a really good fund manager, they can get me 10%. A really good one. A really poor one is going to get me 5%. So yeah, I'm going to get somewhere between 5 and 10% anyway, given trends. So I'm going to want a lot more than that if I'm going to invest that in a business. So typically I'd be looking for, in excess of 20-25% from an ROI. We look at expected payback as well. So this is a really simple but a really good one. So if I'm a serial entrepreneur, serial business buyer, I'm going to want to flip businesses quite quickly. It might well be that I've got limited funds to invest, so I'm going to want to get a repayment on my investment quite quickly, so I can go on to the next one. So looking at the expected payback period, we should always take note of the balance sheet. If not only to write it off for some businesses because it's not really relevant, but we should always understand where the balance sheet sits and understand the valuation if we were to just value it purely based on what's on the balance sheet at the moment. Discounted cash flow, clearly not going to go into the details of discounted cash flow, which we all would have done in our, or those accountants among us would have done in our exams a long time ago. But again, this is the one that takes into account future projections and discounts them to the value today. So we want to understand here exactly what's going to happen in this business going forward, and then the impact that's going to have on the price we're going to pay in today's terms. And then final one we call cash generation. And this is, okay, well, if I take the business now, I look at the cash that's being generated by the business. I understand if I can refinance any of the assets, if I can refinance any of the loans. I understand the period of time which the potential purchaser might like to pay me the consideration, and the number of years that I might like to take consideration over, and that will determine the amount that I can therefore generate for the business. So this is about me saying, okay, well, if I'm willing to take consideration and payment over 5 years, the business can then generate 5 years worth of cash to pay me. Whereas if I want the money now, cash up front, well, that I might not get as high a figure. Now there's risk associated with that as well, but that's another element that we look at. So we've got 7 different valuation methods there which we use, and they provide a rounded business valuation, which is tailored to the specific business that we're looking at. So I'm not going to go into the business valuation model. All I am going to do is say that it's available in that EVA section, and I'll come back and just show you where that is at the end. So I've got to a point now where I've done my due diligence, I've done my value, I've done my due diligence, I've done my valuation. I've looked at that valuation in the context of does that align to what the owner wants? So I've understood what the owner's number is. Is it aligned? Yes, brilliant. We're going to go through the process of selling. Okay, well, that will happen 1 in 1,000 times. So what we're now going to need to do is say, okay, well, it's all, we can't stop there. We can't say, in order to live the life you want to live without the fear of ever running out of money, you need 2 million, your business is worth 300 grand. Never mind, come back to me in 10 years. What we now need to do is we now need to say, right, okay, well, how do we get there and what do we do? So we need to be able to plan to deliver that valuation. So we need to understand exactly what the businesses need to achieve over the next, 3 to 5 years, or however long that period of time is, in order to achieve the desired valuation. So this is just an extract from from the VFD EVA forecast model. Essentially, what we're looking at doing here is the tool enables you to project performance forward, prepare a forecast over the next 5 years. You can build that up by month over the next 2 and then annually thereafter. P&L, cash flow and balance sheet forecast. But ultimately what it's there to do is to say, look, if I take my 7 different methods, I'll just zoom in down the bottom. If I take my 7 different methods, if I look at my my revenue, my EBITDA, and my balance sheet in each of those years, at what point in time am I going to achieve my desired valuation? So if I need £500,000 to live the life I want to live, I know that I should achieve that if I hit my forecast between year 3 and year 4. So now I've got an understanding of not only how my business is viewed and valued, I've got an understanding of exactly how I'm going to achieve my desired exit, and importantly, I understand exactly what I need to do to deliver it. Brilliant. We can all put our feet up and we can come back in 3 to 4 years and then we can get going and selling the business. Well, of course we can't. Because what we're going to need to do is we're going to need to make sure we're on track. So what we need to do is we need every month now, we need to go back and we need to track the delivery against those deliverables, understand which KPIs we're hitting, understand which KPIs we aren't, and more importantly, understand the reasons for either an over or underachievement against those KPIs. So we're going to need to report on that on a monthly basis. So we go back, we compare actuals to forecast, and that's going to help us understand exactly where we are from a P&L, balance sheet and working capital perspective. What we're also going to need to do is we're also going to need to continuously reforecast to ensure the best possible chance of achieving the goals. So not only are we saying this is how you've done, but if based on what you've done and what we know about the future, this is how it's going to impact you going forward. So really important from a planning perspective that we understand that. Then all we want to do is identify when the KPIs suggest that the valuation is achievable. And we can do that all in the same monthly reporting. So we've got our plan. We're able to continually measure performance against that plan. We can report on that on a monthly basis, on a quarterly basis, understand where we are against those KPIs, understand exactly when we think we're going to hit those KPIs, and when the performance suggests that we are going to achieve the desired valuation, we can then go back through that process. So I'm just going to leave that up on screen for a second, because those three elements that I showed you in EVA, in the EVA section of your portal, the EVA due diligence, the EVA business valuation, and the EVA forecast and funded proposal model, help you do all of that. So what options do you have with VFD? Because not all clients are the same. We know every single business owner is going to exit their business. It's how we help them achieve that. So from a VFD, from a, not only a VFD, but also your perspective, there are two ways in which you can work with clients. So you can work with clients on a monthly basis with all associated VFD Pro content, which you can use to help them achieve their desired exit. And that's pretty much this approach here. So going through, working with them, building a forecast out, and using that approach to understand and identify when they're going to hit their desired exit. Or you can use specific project work to suit the needs of the business owners. So a business owner comes to you and says, I want to buy a business, I want to value that business, or I want to sell my business. How can we do that? So now I'll talk to you about how the two different approaches that you can take. So we've got the monthly engagement. As a result of that monthly engagement, using the VFD Pro portal, you've got the full suite, full access to everything. You've got all of your enhanced performance reports. Again, I won't go through these in detail. You've got all of your enhanced performance reports. You've got all of your business growth advisory models, so the strategic models as well as the detailed models. You've got the opportunity exception reports, which at the moment we've got utilities and customer exception, and over the next 12 months we've got a plan to grow that out at roughly one a month. And then we've got the Exit Value Accelerator, or our EVA suite, which helps you do the due diligence, business valuation, and forecast and reporting model. So a lot of content there. Well, how do I use it? So what we've then got is we've got an approach, or a suggested approach, which helps you utilize all of that content. So if you're working with a client on a monthly basis to help them achieve a desired exit, let's say in 3 to 4 years' time, this is an annual cycle that we're going to go through here. So first of all, we've got our fact base. In order to build a plan for the year, we should always do a plan at least once a year. And in order to help us build that plan for the year, we need to generate a fact base. So we've got the business overview, performance analysis, customer analysis, marketing ROI, supplier analysis, the dashboard, everything there to help us understand how performance has been over the last 12 months. So how profit has moved year on year and what the drivers of that profitability have been. We've then got our strategic planning tools. So business growth model, client segmentation model, customer targeting model, and they're there to help us set the high level aspirations annually for that business. So we can use the business growth model to work out what the customer acquisition, customer retention, margin and overheads needs to be. We can use the client segmentation model to help us understand if we change the mix of services that we're offering, what impact that has on profitability. And then we can use the customer targeting model to help us identify where the low-hanging fruit are within our existing client base. Once we've done that, we've got the detailed planning phase, which is where we take our forecast and funding proposal model, along with the scenario modeling, which is within that model itself. And typically that would be around about a 90-day process. So we'd have a 90-day process where we would utilize much of the content within VFD to help us set the plan. What we would then need to do is we would then need to report on that on an ongoing basis going forward. So if I've got phase 4, which is our reporting and reforecasting phase, so always every month I'm gonna report against forecast. So 30 to 60 minute Zoom call with the client, performance against forecast. I'm going to use the board summary, I'm going to use the performance trend, and if applicable, I've got the non-financial KPI reported as well. So that's what I'm going to use as my monthly pack with my client. On a quarterly basis, I'd have a bit more of a deep dive. I'd understand a little bit more of the detail. I'd still do my performance versus forecast. I'd use my board report instead of my board summary, and I'd understand from a benchmarking perspective how they're doing, and I'd look at my opportunity exception reports as well. So we've got our fact base, which is phase 1, strategic planning, which is phase 2, detailed business plan, which is phase 3, and our continual reporting, reforecasting, and assessing business valuation is phase 4. That's an annual process that we go through. So if I'm supporting my client on a monthly basis, I'm going to utilize the entire suite at some point over those 12 months. And I'm always going to constantly be referring to performance against that plan, and that plan was to deliver a number. So that's where we're working with a client. We've then got specific projects that we might want to get involved in, and for that we've got labeled really creatively EVA for buyers, where if I'm acting for a client to buy a business, I'm going to want to do the financial due diligence. I'm going to want to be able to prepare a valuation. I'm going to utilize the performance trend report to understand exactly what's been happening over the last month, 3 months. I'm going to use the customer and supplier analysis to help me understand the key customers, key suppliers, and whether there's any risk. I'm going to utilize the client segmentation model to help me understand not only the existing mix of business within that business, but also what impact a change in mix or introducing new service channels or new products might have on that profitability. And I'm going to also want to utilize the forecast model to help me understand what the future would look like within that business. We've got EVA for sellers, which is similar but requires a little bit less content. I'm still going to want to understand from a financial due diligence perspective how an independent observer would view my business. I'm going to want to be able to prepare a valuation. I'm going to need to understand and provide customer analysis and supplier analysis and monthly management accounts to a prospective buyer. And then I'm going to want to be able to show what the performance of the business could look like in the future from the forecast model. And then we've got EVA for valuers. So if I take the, let's for instance, take the unfortunate event of a divorce, where we have to just value a business in order to produce some sort of settlement. I'm going to need the financial due diligence again. I've got some reporting which helps me understand what's happened in this business over the last year. I've got my detailed valuation model, and then I might need some monthly management accounts to back that up. So whichever route you want to go down, whether you want to go down the helping a client on a monthly basis achieve a desired outcome, which we have a number of accountants working with clients doing that at the moment, or whether you just want to use it for specific projects. So we've quite a few VCs which use the project approach because it's nice distinct projects that they can use the output and content for specific project activity. We're there to support either of those. So what I want to do now is just go back and just refresh your memory on exactly how you would access all of that content. So I'm going into the demo company. There's the webinar demo that I loaded at the start. It is only demo material, so I won't go into any of these reports. But in the time it's taken me to do this webinar, we've got all of that content that's being created. If I open up that content, you'll see that it's only demo data, which is in there, or 0 demo data. So there's not a great deal of content in there, but that's all being created in this time it's taken me to do this webinar. So we've got the financial due diligence. I'll just open it up to show you. So you've got the financial due diligence that you can open up, which we can see here. So we haven't got 3 years worth of data, so that's why we haven't got much information within there. Then you've got the ability to prepare a business valuation based on the information you've got, and then to prepare a forecast as well. And then for grow and exit, working with your client on a monthly basis, you then have access to all of the rest of the content. So hopefully that's helped you understand exactly what we can do with VFD. We can either take the monthly approach or we can take the project approach. I know some of you aren't currently VFD clients. If you want to take out a free trial, go to vfd-pro.com/free trial. Or if you want to discuss EVA with anyone of the team or myself, then you can email support@vfdpro.com. We do have a couple of minutes. Has anybody got any burning questions they want to put into the chat, or come off mute and ask? If not, then thank you very much for your time.
Hey, Mark, are you going to make these slides available?
Absolutely. Yeah, I'll send the slides out in a PDF form to everybody that's been to everyone that's attended the webinar. And you'll get an email. I think it's planned for about 4 o'clock. You'll get an email which will allow you to just request a copy of the recording as well if you want to.
Okay, thank you.
Okay,
If there are no further questions, thank you very much for your time, everyone. Like I say, just email support@vfd-pro.com if you've got any other questions, and we can get back to you.